Howdy, Jacob here. Today we're looking at Rowe Price Group. They are in the capital markets industry, 24 billion market cap on 21.6 enterprise value. So net debt negative, meaning that their balance sheet likely has more cash on hand than debt, or that's literally what it means. Their margins are actually down. Revenue is up quite a bit, but a huge drop recently. So gross margin 63% down to 55%, operating margin 47% down to 38%, and then return on invested capital is also down, but still pretty hefty double digits. I mean, if you're thinking 22 is an outlier, then you're looking very positive. 3.9 earnings per share to 13.1, 3.5 revenue to 7.7. Average return on invested capital is low mid 20s%. That's pretty substantial. I've had offerings in my 401k for T. Rowe Price. They've been around since 1937. That's quite a bit of time. They help do a lot of 401k stuff. I know that. Outside of that, I don't know too much else. 4.6% dividend yield. Attractive balance sheet. So no long-term, short-term debt, and then 1.7 billion on cash equivalents. Beautiful balance sheet. Love to see that. Okay, cash flows. 5-year average basis. Probably looking at $2 billion here. Acquisition, just one acquisition in the last 10 years in 2021. And it looks like there were some devastations out here, not from acquisition, but and investments, sell-off investments there. It looks like their use of cash is really just share repurchases and issuing debt. So 1.1 billion aggregate payout of their dividend is about 55% of their 5-year average, $2 billion. And then it looks like with the rest, they just buy back shares. And so I think I'm ready to start making some assumptions here. Okay, so let's say that it's probably 3% revenue growth. And then down the line, they'll still probably have a bit of growth ahead of them. Just thinking, I mean, what if the market's not necessarily flat, but more negative than the previous years? That could hinder their ability because then less people invest in their 401k. I'm going to do 2%, but still have a premium on their P and price free cash flow because although they pay out so much in stock repurchases and issuing debt, if they find an opportunity to invest in, they can invest heavily in it and get a great return on that investment. Looks like I don't like that their free cash flow is lower than their earnings margin, but at least the last 2 years has been higher, so that's good. We'll see if that sticks, though. On an average basis, we're looking at like 34, 28. Well, let's do 34, 30. Maybe let's do 32, 30. So, I mean, it's all an art. I could walk you through kind of my logic, but really it's like an average and then just saying that maybe just because the margins have been going down over the last 10 years, I'm taking kind of a little bit lower, a little bit conservatism there. And then saying they buy back 1% of shares. I mean, the 50%, they can afford that, 55% payout ratio on a 5-year average basis. They can really afford that. They don't have any debt, so they just have cash on hand. I think I'm comfortable sticking with their. I think I'm comfortable saying that their dividend is going to stay the same, and that gets us to a price that's really not too far off. 30%, given a 15% return with these assumptions, I would say that this would definitely be a company to add to my dividend yield screener. They've been paying a dividend consistently and been increasing it for the last 10 years. And so I think this is definitely a great company to have in your dividend portfolio. Again, not financial advice, but everything you invest in should be to you. So if you're catered to just make 4% and you don't care about the appreciation of stock, this could be a great buy because you might get even a little bit of price appreciation here. Let's say 5%. Yeah. You'll probably get a little bit of price appreciation beyond the dividend. But for me, I care most about return as still working, don't plan on quitting anytime soon, and I just want as big of a return as possible, or a reasonable return that's well in excess of the market, likely. And to me, I just wait to get a little bit more price appreciation here, but definitely seems like a solid dividend. And the biggest things I look for are healthy balance sheet, healthy cash flows, and this definitely achieves both of those. So hopefully you enjoyed the video. As the rest of the day.